Trustees meeting for April 29th, 2004. And first order of business will be our investment report. Mike Clackett. Sorry. I know, they are. They dig in to the carpet. Thank you, sir. How you doing? Thank you, sir.
There we go. Green light on. So we're going to start with the
Where we at?
investment
I'm sorry.
investment summary on page 12. So although things have been extremely volatile in both stock and bond markets, actually a little more volatile in bond markets than stock markets due to interest rate movement. If you look to the left-hand side selected period, that's for the first quarter. Pension plans up 5.5%. Bond market's down about 0.80. Stock market down about 8.18. I'm going to have you if you go to page 7 of the report, just to show you what happened on the bond portfolio of the Upper Darby Police Pension. Turn to page 7. At the top of the page, you'll see for the quarter, intermediate corporate bonds at the top of the page were down 0.23%. High yield bonds, which we had a bias and a lean towards high yield in the asset allocation strategy for over a decade. That was actually up 1.53. Remember, the total bond market was down 0.8. High yield bonds were up 1.53. So having a lean towards high yield bonds really helped the overall bond portfolio. The total bond market, which we're invested in through the Vanguard Total Bond Market Index, was down 0.61. The short-term bond fund was down 0.12. So what we also did is we shortened the duration on the bond fund, thinking that interest rates were going to stay higher for longer and actually move upward, not downward, and that's what continued to happen. So at the bottom of the page, your overall bond portfolio was down 0.44. And again, back on the page 12, the total bond market was down about 80 basis points in total. So you had better than bond market performance. It's harder to beat the bond market than it is the stock market. And mainly it was where we thought interest rates were going to go, and also having that high yield exposure to get a higher return. Even though the bond market is down, you're having even institutional clients start to question why you have a bond portfolio in place. Your bond portfolio is what we use as risk management, and the stock portfolio is what we use to get return, right? The coolest decision we made as a group back in 2011 was, in order to try to hit your assumed interest rate, which was a lot higher than it was now, we leaned more heavily towards stocks than bonds than most municipal pension plans across the country, and went 70% equities. That's helped us not only since 2011, but it also has helped us so far this year, because bonds have done much better than stocks. If you go to page 9, the performance report. Towards the bottom of the page, your stock allocation, your equity allocation was up 8.03 for the first quarter. That the total stock market was up roughly 8.18%. So we were slightly trailing the overall stock market index. That was mainly due to, if you still stay on page 9, you look towards the bottom, you see mid-cap stocks were up 8.79% for the quarter. Small cap stocks were up 3.98%. Large cap value up 9.52. Having that lean towards small company stocks, which right now are the selling at the best price. They're on sale more than any other asset class. That's what made the drag on the equity position in the pension plan. And if you just flip over to page 8, towards the middle, you'll see international stocks are up 4.86% and large cap growth are up 10.84%. So the leading asset class for 2024 is still the same leading asset class in 2023. Your large cap technology stocks are still running the market. What that means in our strategy is that since you own almost 6,000 stocks through the all market indexed approach, there are over 5,000 stocks that are still undervalued on sale. We think that's pretty significant and a pretty strong story, which is why we recommended to continue with the 70-30 allocation mix in order to have a greater probability of hitting your 7.25 assumed interest rate. And in fact, if we go back to page 12, sorry for flipping around here, guys, but back to page 12, since inception, your performance has been positive 7.74. That's as of May 24th, 2011. So you've had 7.74% total return average. The stock market during that time frame did roughly 8.91. The bond market did 1.88%. So the biggest decision, again, that we made together, but we made on your behalf, was to choose an allocation slightly more aggressive in order to try to hit the assumed interest rate. That was worth almost 1 full % in total return over that time frame. Looking forward, we don't know a more efficient way to manage a pension plan than having the diversity of owning everything. Because if you started to listen in the beginning of the year, everybody thought that large cap growth was overvalued, and they were leaning towards large cap value, thinking that eventually those positions were going to come down. We take human nature out of it. The process is so efficient. We're always going to buy the asset class that goes down, sell the asset class that goes up, keep the portfolio in place. So we'll always be buying on sale, and eventually I'm going to look right. I just can't tell you when. Same thing with the bond market. So with the bond market being down, give you a great example. Last year, the bond market finished up over 5%. It was almost negative 5% going into the fourth quarter and made up almost all its returns from interest rates moving down over a 3-day period. So we think there's certainly never been a better time to practice asset allocation on the bond market and the stock market. In fact, now you're going to get a higher yield from the bond market, and eventually when interest rates do go down, we would suspect to get a pretty nice bounce. In fact, if you look at the overall bond market now, if it were to move in 1% in either direction, if you took a look at the total bond market, you would have almost a chance of an 11% gain if it went up if it dropped by 1%, and if it went up by 1%, you would only see about a 2% loss. That's how undervalued bonds are right now. And eventually we do suspect that interest rates will start to drop. So the three things that are most important are keeping the portfolio in check to try to take the least amount of risk to try to come close to your overall assumed interest rate. We've done that over time. Your valuation is on a biannual, every other year period. So your next valuation will include last year's performance of 16.87% return, plus you squish it together with whatever we get this year, and then that'll drive that valuation going forward. So right now, what we're recommending is to stay the course. I also put on the right-hand side, these are all the earnings that are coming out this week. So we already had half of the S&P 500 report to this point already within, just within about a week. Most of the companies have surprised to the upside, so we've had better performance than expected. We think that's going to continue, but you're going to get some key looks into what the marketplace and what the consumer are doing. The consumer drives everything here in the U.S. You're going to have CVS reporting on Wednesday. You're going to have Amazon reporting on Tuesday. You're going to have MasterCard reporting, but all these big names all coming out, and we think that the earnings are, again, going to surprise to the upside. At the end of the day, that's what we take a look at, price of stocks versus earnings, and what's the allocation strategy that we need to hit your assumed interest rate over time. So we'll take a peek. This time next year is going to be probably the most important time frame, because then we'll have an idea of where we stand on the valuation. We could talk more about interest rates and what allocation strategy we're going to hit depending on what that assumed interest rate will be. That's the most important thing that we've done with you guys over our time frame of having the privilege of working with you. Any questions on where we are?
I did have a member email me, but I think you've already may have answered his question. And the member, he used to sit on this board. The markets have rebounded. His question is, how do you feel about bond markets? And do you see recovery at all? You just spoke about that, I think.
Well, I can add a little bit. We thought that the Fed was going to hold rates higher for longer. We believed what they said more than most did. We think they're making a mistake by keeping them up higher for longer, but we believed them, right? So by doing that, it has hurt the bond market. And eventually we think they're going to start moving downward, but they've been data dependent, and depending on what the dot plot says, that's what they're going to do. So that reward is going to come later, Jeff. You're going to be, finally, retirees are going to be rewarded for having bond holdings. Mm. It's just going to be longer than was expected. So everybody thought, the markets were telling you that there might be that the Fed might lower rates 6 times. Now it's looking like once towards the year end. Mm-hmm. So you're probably going to benefit more from the bond portfolio towards year end or beginning 2025, but you still need them in the portfolio. And in either case, whether it's the bond market or the biggest question I'm getting now is about elections, the process is so efficient, we're going to take advantage of whatever happens. And unfortunately, it's usually bad events that we benefit most from, because we'll rebalance. So if stocks get hit, we'll use bonds to buy stocks cheap, or vice versa. But the election is a great, historically, whatever happens in the election, we're going to take advantage of it, whether the market goes up or down anyway, and we're going to benefit here through the allocation strategy. Same thing with bonds. You need bonds, you need stocks. Bonds, risk management. Stocks are where we get the growth.
Okay. The other question was, there seems to be a poor return on cash. Should we be getting a 3.5% minimum? CDs are up as well.
Yeah, cash right now. So that's part of the here. We're using the Schwab money market. So you're getting roughly about a 5% yield. That's part of the problem, because what happened to your institutional investors last year in the third quarter, they saw bonds down 5%, and they saw money markets paying 5%, what do you think they did? They sold bonds and moved to cash, right? Well, what happened is bonds got all the return in like 3 days, right? And made like 9% in three days to finish positive above money markets. So you're seeing retail investors fly from bonds to go to money markets because they're paying a higher rate. But eventually, right now, bonds are very attractive because they're selling cheap, and eventually you are going to see interest rate movement downward. But we're also taking advantage of that in the pension plan, where we hold cash at about 3% to be able to pay bills, pay pensioners. A majority of that is in the money market of 5%. So, but over the long run, your bonds and stocks are going to deliver the higher return than cash eventually. When you see interest rates move down, money markets are going to be the first thing to drop, right? But they'll drop mortgage rates after, because they're making money from mortgages. They're paying money out from money markets. So all good questions. We taught that pension plan person well.
Yeah. Okay, that's it for me. Thank you.
Thank you.
David Reed, actuarial report. Thank you, sir.
Thank you, everyone. So what we have today, because we're in an even calendar year, as Mike had mentioned, the valuations and the reports that are used to generate contribution requirements are done in the odd calendar years and set forth the basis for contributions for the following 2 years. But at the end of every fiscal year, the township needs to report certain information around the pension plan and its financial statements. And that's what this report is. It's GASB pronouncements 67 and 68. So this isn't necessarily anything that this board's going to use to make decisions on, but it does kind of give you a feel for the snapshot of the plan at the end of 2023 that might interest you. It might prompt some questions. I can take you through this, kind of dipping into the world that, that we play in. And I'm sure you're going to be blown away by how interesting it is. So the first couple of pages are some commentary. It goes through some of the information that GASB, tells us what to do. What they're looking for in GASB is a very transparent look at the pension plan on a market basis. So in here, one of the exercises we do from a GASB's perspective is GASB wants to know not only what do you look like today, but as part of that exercise, we need to do some projections out as far as we can based on the current population of the plan. We have to project the assets and the liabilities, the contributions, the benefit payments out for this population until it all goes to zero. So as you know, that could be quite some time, 80 years or so. And if you ever get to a point where there's a date in time where there is not enough assets to satisfy the distributions owed to participants, you need to kind of stop what you're doing and then reevaluate how you determine that liability. You need to take yourself away from a long-term rate of return approach and look at a municipal bond index. So the difference in those rates is usually pretty significant. So 7.25 on the long term, that muni bond index is probably 4 something, maybe 3 something. And then you need to kind of mash them all together and come up with a different liability. And it's usually you find that in a plan that's, not maybe poorly funded or is having contribution issues. We've had some entities in the past, not this one, may make that clear, that had taken some contribution holidays. So the amounts that were supposed to go in didn't. And you see that really play out way down the line when you do an exercise like this. So this is more than just a snapshot. Behind the scenes, there's a lot of kind of forward-looking stuff going on. Happy to say there's no projected run-out date for this plan. So let me jump ahead to page 3. Just some really quick snapshot statistics. The top of the page is going to show you the group of employees or the group of participants in the plan at the end of 2023. There's 158 inactives. So those are folks currently receiving pension benefits. And there's no one who's terminated but hasn't started yet. And there's 130 active officers in the plan. So 288 total. The active liability is 45.8 million. Inactive liability is 85.7 million. Total liability is 131.4 million. The service cost number is the amount of pension benefits that the active officers earned in fiscal 2023. So that's a year of service for everyone and some interest on that. As liabilities grow forward, they grow with interest. And the covered payroll for the group was just under 18.5 million. That liability amount for the inactives does include the newly implemented drop program. So there's several officers there where we're tracking drop payments off to the side. That drop balance at the end of 2023 was $214,703. So that's the accumulation of all their drop payments at the end of 2023 that will ultimately get distributed once they actually retire. Page 4 is kind of a concept, certainly for this board, that we really don't talk about much because it's not the way that you make decisions and judge the plan. That's pension expense, and that's really like an income statement for the plan on the township's financial statements. So think of service costs for the active employees almost as like an employee cost. That's year over year, it grew from 4 million to just under 4.5. Interest cost is interest on the plan's liability is exactly what it sounds like. That's relatively steady because the interest rate stays the same, 8.6 million the prior year, 8.8 2023. One of the items that offsets expense is what you expect your assets to do in performance. So that was 8 million the year before. And remember, 2022 was a year where, from an investment standpoint, you couldn't hide anywhere. And then that projected earnings for calendar 2023 was 6.6 million. The plan incurs expenses to operate itself. You record that as a line item. The employees offset some of the costs through contributions. That each year is 866,000 versus 986. And then there's some amortization payments that I'll take you through on the next page. But essentially, the pension expense or the impact on a profit and loss ability if you were a corporation is 6.35 million in 2022, and it was an improvement to 5.1 million in 2023. The next page, you'll have to flip it to look at it on a landscape basis. As with the funding valuation, when changes happen, whether they're gains or losses on the every other year valuation, or whether you make changes due to assumptions or you change plan provisions, you don't recognize and absorb the costs of those or the benefit of those all at once. You spread them out over a period of time. And GASB has some guidelines on how you do that. Any investment experience is automatically divided by 5. You're gonna realize any asset performance over or under what you expect over 5 years. So you'll see in 2023, you had overperformance of 8.9 million, and we'll spread that out over 5 years. So you're gonna capture about 1.8 million of that a year for the next 5 years. Liability experience and other changes are done a little bit differently. You have to spread them out over the average remaining service years of the whole group. The whole group, meaning all the retirees too, which are 0. That's why that number is 5.8. Clearly the average of just the active officers, the average remaining years is way higher than 5.8. That average is brought down by the 158 inactive folks in the plan. So that's how this amortization schedule works. No reason to really go through every single one of them, but just wanted you to see that. The next page is probably the one that gets the most attention. It's kind of front and center. It's the balance sheet of the plan. This page would probably get a lot of highlight in the township's financial statements. And if you move across from one column to the next, you have the plan's liability, you have the end of 22 and how it changed to get to the end of 2023. So you can see we talked about the service and the interest cost. The plan paid out 8.1 million of benefits to participants. And we had a liability gain of $2.2 million. That's largely attributed to the fact that you're only capturing census data every 2 years. So that data updates itself, and the results play out. The middle column, planned fiduciary net position, is a very fancy way of saying assets. So your assets grew from 93.8 million at the beginning of 23 to 107.4 million, including the drop balance at the end of 2023. So you can see there you had net investment income of 15.5 million. You can see the contributions are split out between township and employee, and then the expenses we covered. So at the end of the day, on a net basis, the plan was $34.4 million underfunded at the end of 22, and it was $24 million underfunded. So you improved by over $10.4 million of funding improvement at the end of 2023. Below this is something a little bit interesting. GASB also wants to know what these numbers would be if we use different discount rates to generate the liabilities. So kind of how sensitive are you to a change in discount rate? If we were to lower you from 7.25 to 6.25, that $24 million unfunded amount would grow to just under 40 million. So that's the power of that change in interest rate. That's how sensitive, you're roughly $15 million sensitive to a 1 percentage point move in your rate. On the other flip side, if you were to raise that rate, which we're really not in an environment to do that with any kind of support now, your funded status would drop to only being $11 million underfunded. So like I said, this is probably one of the pages that gets the most attention when someone would look at financial statements. Deferred inflows and outflows of resources on the next page is another way of saying all those numbers on the landscape page, those amortization items. If it's a cost amortization, it's an outflow of your resources. If it's a gain, like that asset gain from 2023, that would be an inflow. So this just summarizes this. Probably the most people interested in that are the auditors. And GASB also requires, not necessarily in this report, but in the financial statements that the township would publish, a 10-year history of this information that I'm sharing with you today. So that page where we went through the 3 columns, the funded status, there was 10 years of history in here for that. And then on the following pages, they want to see what were the contributions that you were supposed to make and what did you actually make to the plan. And that's here on page 10. You can see for 2023, 5.16 million was required. That's what went in. You can see here there's no variance on that first page. The contributions for the last 10 years have always been what they were supposed to be. So good news. The rest of this, page 12, is a very, very, very high level summary of the assets and what categories they're in. And then on pages 13 and forward is a summary of all the assumptions that we make, the discount rate I talked about, how we're assuming salaries grow. And you can see here, we're assuming they grow pretty quickly at the beginning of an officer's career, and then they plateau out to a more long-term average. And that was bore out by a study that we did. We're kind of making some estimates on rates of disability. We've had plenty of conversations about this in the past. Whether the incidence of folks not working a full career, you're kind of baking all that in to come up with your liability number. Life expectancy we've talked about, we're kind of at the, exactly where you're supposed to be. There are public plan specific tables, and there's an assumption that longevity is going to improve in the future. That's all being taken into account, as well as what age people actually retire. So, and then following the assumptions and methods is just the plan provisions that we're valuing, that are coming right out of the CBA and the plan documents. So, any questions on this? And then from our perspective, the work that Kevin and I do, my colleague Kevin Santon is here. Kara has the statements, so the annual pension statements are done, and then we take retirement questions and requests and calculations as they come in. As we get toward the summer months, maybe June, we'll start asking the township for like projected payroll data to give them their MMO for 2025. They already have it for 2024. So an even calendar year is a little bit light. I wish all my clients did their collective bargaining in even calendar years, but it doesn't always play out that way. Is there any questions on any of this stuff, what I presented, or actuarial topics in general? No? All right,
No,
thank you.
sir. Mm. Thank you, David. So we'll do the authorizations for bills. Payment to CBIZ INR for the 2023 GASB 6768 actuary report. Annual pension benefits, it says in progress, but I believe they're now complete. Review AG 385 and death benefit calculations in the amount of $3,240.95. We do them all together, then get a roll call vote, or do them one
Do 'em
separate? Okay, okay,
Do you want me to make a motion?
yes, please.
So moved.
I have my second, all in favor, is aye?
Aye.
Aye, ayes have it. Payment to Cozen and O'Connor, Attorney Robert Kaplan, who is online, for professional services, attorney fees for the first quarter, January 1st through March 31st, in the amount of $1,680. Motion, please.
So moved.
All those in favor, say aye.
Aye.
Aye, ayes have it. Payment to Kara M. Gavin for,
I feel expected when he says it.
we're going to vote against it since it's already paid. Payment to Kara Gavin for secretarial service for the second quarter of 2024 for $350.
Wait, actually, can I, is it second quarter or is it first quarter of 24?
You shouldn't change it.
Should be first quarter of 24.
First quarter.
Because we're in the second,
Yeah, we just completed
we
that.
just finished the first quarter.
Yes,
Okay.
and I should have called it too. You're
It's a
embarrassing me.
tough day.
Okay, there's again, payment to Kara M. Gavin Secretary Services for the first quarter of 2024 in the amount of $350.
So moved.
All those in favor say aye.
Aye.
Aye, ayes have it. Acknowledgements. The drop retirement for Captain Anthony Vaughn, effective March 28th, 2024. We don't have to vote for that, do we? No. And resignation of Police Officer Weston Menzie, effective April 23rd, 2024. He is going on to accept a position in his hometown. For discussion, anybody have anything for discussion? And Rob, feel free to jump in if you have anything.
Nope, I don't have anything. Thank you.
I heard you, but I can't hear you.
I was saying I don't have anything. Thank
You turn
you.
him up, Kara? Give Kara a second to turn your volume up. Did you have something? Okay. Let's try now.
I was just saying.
you go.
I don't have anything.
What's that? She has you up as high as it. One more time.
I don't have anything.
bring
Thank you,
your-
everyone.
All right, there you go. That came through loud and clear. Okay. Mr. Say, do you have anything for discussion? If not, you can also address us when we go in the executive at the end, where we turn off the internet. Okay. Anything for old business on the record? Okay.
Nope.
No. Yeah, I guess we'll address that. New business. And the distribution of 2024 benefit statements, I believe I'm going to take custody of those this evening. Okay. I'll start handing them out this week. And if nobody has it, nobody from the general public is present, if nobody has anything else, I'll make a motion to adjourn the meeting. Can I have a second?
Second.
All in favor of adjourning this meeting, say aye.
Aye.
Aye, ayes have it. Meeting is adjourned. Yeah, if you could just cut the internet, we'll go into.